This week on Wealth Track, building a sound foundation for retirement. Award-winning financial planner Erin Botsford starts with guaranteed income first to make sure retirement needs are covered. The Botsford Group's Erin Botsford next on Consuelo Mack Wealth Track.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Thornburg Investment Management, active management, global perspective. And the Fairholme Foundation.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. The investment handwriting has been on the wall for a long time. It's just starting to sink in. The long-standing assumption that portfolios of stocks, bonds, and some other holdings would generate 8% annual returns is no longer a given. As the Wall Street Journal reported recently, public pension funds from California to New York are cutting investment return predictions to their lowest level since the 1980s. According to the Journal, more than two-thirds of state retirement systems have trimmed assumptions since 2008. Among 126 plans, the average target is now 7.68%, the lowest since at least 1989. The peak return expectation was 8.1% in 2001. Now, over time, these lower assumptions are going to mean lower benefits for retirees and bigger pension liabilities for governments. Meanwhile, according to another Journal article, the California State Teachers Retirement System, known as CalSTRS, the nation's second largest pension fund, is considering a significant shift away from some stocks and bonds, one of the most aggressive moves yet by a major retirement system to protect itself against another downturn. According to the Journal, about 55% of CalSTRS' $191 billion portfolio is in stocks. As part of what it refers to as these risk mitigating strategies, it's considering moving as much as 12% of its total portfolio into U.S. Treasuries, hedge funds, and other complex investments it hopes will perform well if markets tumble. Well, this week's guest is ahead of the pack in implementing risk mitigating strategies for her clients. She is Erin Botsford, a certified financial planner and founder and CEO of the Botsford Group, a boutique financial planning firm that specializes in retirement and asset protection strategies for business owners and executives. Botsford has been named one of Barron's top 100 independent financial advisors and one of its top 100 women financial advisors. She has trademarked her lifestyle-driven investing philosophy, which she explains in her book, The Big Retirement Risk: Running Out of Money Before You Run Out of Time. An independent thinker, Botsford is critical of traditional financial planning approaches such as asset allocation strategies, set systematic withdrawals, and what she calls the myth of the magic retirement number.
The idea that you can have this magic number,
right,
and let's say everybody wants to have $1 million, and they're saving and saving and saving, and let's say they're doing it in their 401k, and pretend, let's go back a few years, pretend it's July 2008, and you're working at General Dynamics or some great company, and you said, as long as I can have $1 million in my 401k and my house is paid for, I'm good to go, right?
And I've got Social Security, then I'm golden.
Sure, you're
right.
golden. And then 2008, the financial crisis happens, and your $1 million is now down at $700,000. And poof, all of your dreams evaporate. Now, can you retire or not? You know, you had determined you needed $1 million. Well, you don't have it.
And you needed that 5% withdrawal or the 4% withdrawal, whatever it was, to maintain your lifestyle of that $1 million. So now you've got $700,000.
Right, and so what do? Do you decrease your lifestyle by 35, 40%? Do you stay working? I mean, to live like that and to depend on achieving some magic number, to me, it's like insanity.
So therefore, what is the goal? What should we be trying to achieve? As you've got to put a number on it somehow, because if you assess what your needs are to live in retirement, you need a certain amount of cash flow. So you've got to somehow get a financial number that's going to generate that kind of cash flow. So where do we start?
Well, okay, if you back into it, so here's my first premise. This whole $1 million goal is built, most people use modern portfolio theory, and they buy a bunch of stuff and they put it in a pie chart asset allocation, right?
Yes.
So they don't just have one investment, they have maybe 20 or 10, however many their 401k has. And then someday when it reaches $1 million, they're going to take that 4 or 5% out, and that's supposed to take care of them for the rest of their life. Well, Consuelo, that situation, I have found it only works in 2 situations. One, if you're still working and you don't need to touch that portfolio, right?
Right.
Or if you have other resources, then it works. Or as long as the market's going up, that 4%, that systematic withdrawal works out beautifully. The problem is, in the other situations, if the market's flat and you take out 4% or 5% over and over and over again, and you're depleting into your principal because the market's not going anywhere, or if the market goes down, I mean, literally you could get yourself into a downward spiral that you could never recover from. So just that whole pie chart asset allocation systematic withdrawal is dead. It just doesn't work. So you asked me what I would do. Well, I developed a concept called lifestyle-driven investing, and it's kind of like begin with the end in mind. And so what we do is we build a client's house of security, because in my mind, not all expenses are created equal. I think paying your mortgage or your rent and your health insurance and your utilities should take a higher priority than your country clubs and your vacations, right? It doesn't take a rocket scientist to gauge that when I'm retired someday, I'll have my Social Security, yes or no, so maybe that in a couple, that's $30,000 a year. But your total needs, let's assume maybe you could have paid off your house. So you've still got utilities and you've got health insurances and that sort of thing.
Food, transportation.
Maybe your total needs is $80,000.
Right.
Well, you've covered 30, right?
Right.
So now you got to make up the 50. Well, what I think you should do is start investing in things that produce, we call them lifestyle investments. Well, what is a lifestyle investment? Well, it has to produce an income either now or someday in the future. And I say, if it's going to fund your needs, that income should be safe or predictable or guaranteed. So a lifestyle investment is just a filter that I think people should look, what are the attributes of the investment? And if I put my money in that now when I'm 40 and I keep adding to it, can I turn on an income, and will that income be enough to sustain that $50,000 net differential that I need?
Right.
Does that make sense?
That does make sense. So where do I go for a guaranteed income that's going to provide, let's say, $50,000 a year in income, especially in today's low interest rate environment? Where have you found those kind of vehicles for your clients?
Well, you said the magic word. Where do I go for guaranteed income? There's only 2 places that you can go for something that you would call guaranteed. One would be the US government and put it in treasuries. Unfortunately, you'd have to have $10 or $20 million, because interest rates in that environment are so low. The second place you can look are annuities. And I think annuities have gotten kind of a bad rap. But right now, there are guaranteed sources of income paying 4, 4.5%, 5%, even in this environment.
Tell us about why you've gone to insurance as opposed to the stock and bond markets for meeting the income needs.
Well, that's a really great question. And I will tell you this. I think that it's interesting that we as consumers tend to buy a lot of insurance. Like, I bet all of your listeners have health insurance, right? In case they get sick, they want to transfer that risk of the hospital stay to somebody else, i.e. an insurance company. We all have automobile insurance, comprehensive and liability insurance. And most people, probably listening to you, if their car was completely damaged, totaled, they could probably write a check to buy their next car. But they have that car insurance, and then they have mortgage insurance in case their house burns down. Well, I keep thinking, the single greatest amount of money is needed to support your lifestyle in retirement. So say for 40 years. So why would you not want to insure or transfer the risk of a market meltdown to an insurance company? It makes perfect sense to me.
One of the things that you said earlier, annuities have gotten a bad rap because they used to, number one, they can be extremely expensive, they can be extremely complicated, and many financial advisors don't actually recommend them because if you buy an annuity for some financial advisors, it's taken out of their assets under management so they don't get a fee on it. So there are a lot of reasons why annuities have gotten a bad rap. Have they improved? Are there more choices now? I mean, is it and is it something that we should look at? Again, annuities as a core part of funding my basic needs part of my portfolio.
Yes, and you said it.
Yeah.
It's as a core part of funding your basic essential needs, things that I call them your non-negotiable items. You don't want to wake up one morning and the market's tanked by 50% and you wonder, oh my gosh, am I going to be able to pay my mortgage payment? You don't want that. So there's some level of security, I think, that you want to put in your portfolio. So I don't really know. I will say this, it's kind of interesting because there's a lot of financial advisors, truthfully, they do not maintain the appropriate licenses to sell annuities. Okay. So if I was a person that all I could sell were Mercedes cars, and somebody came to me looking for a Lexus, but I couldn't sell them a Lexus, would I recommend that they go down the street and buy a Lexus?
You're not going to offer it to them.
You kind of have to figure out what's the motivator there. And so there's a lot of advisors in the last 10 or 15 years, they gave up their FINRA securities licenses so they can't touch or recommend annuities.
Oh,
so
that's interesting. So that's an important credential to look for then. Therefore, there are a lot of different kinds of annuities. What are the annuities that kind of are the go-to annuities that you think that we should be at least considering, again, to fund our basic needs in retirement?
Well, in my book, I talk about there's 4 types of annuities, and I try and make it very basic. The first kind, I call it a pension annuity, and that would be, a lot of people retire from big companies like IBM, and when they retire, after 30 years, they get a pension of $60,000 a year. What's the problem with that? Is usually, maybe they can insure them and their spouse, but there's nothing left for the kids. But I always try and say, I'm a product agnostic. Now, what if you came to me, Consuelo, and you said, I've got an 83-year-old mother, and all she has left is $300,000. I want to get her, she's very independent, she wants to live on her own, I want to get her the largest amount of income I can get. And I'd say, well, gosh, she's 83 years old. If you could put her in one of these pension annuities and probably get her a 8 or 9% return. The negative part is you give the money to the insurance company. When she dies, chances are there's no benefit. But most people say, I don't care. She wants to maintain dignity. She wants to be able to support herself. So that's one kind. The second kind are just fixed annuities, and they're very much just like a CD or certificate of deposit. And so it's just, you give the insurance company set amount of money, $100,000. They pay you a fixed rate of return, 2 to 3 to 4 years. They give you your money back. And it's interesting, in my state of Texas, or we do business in Texas and Georgia, one of the reasons people buy annuities in that situation is Texas offers asset protection. So if I'm a doctor and I have liability risk on my money, instead of putting my $1 million in a CD at a bank, if I put my $1 million in an annuity, a fixed annuity in the state of Texas, they actually get asset protection. So I would encourage your listeners to find out what the liability and asset protection laws are in the various states that they reside in, because that's kind of interesting. And then the third kind are variable annuities, and I think I talked about that in the last time we were here, but we can certainly explore that later. And then the newer one that's kind of come along are equity indexed annuities. And I should say, Consuelo, there's no perfect investment.
No, we all know that.
And so I think, there's pros and cons to each one of them, and I don't think all of any kind of annuity is perfect. There's a lot of junk out there.
What role does the stock and bond market have in your basic needs portfolio? Does it play any role whatsoever?
Well, I think that's a great question, and I haven't always used annuities.
No, I know you haven't.
You have to go where you have to go.
Right.
20 years ago, I was trading bonds. I was a big bond trader, and when you could get 8 or 10% yield on a municipal bond even, or a corporate bond, that's where we went. But that doesn't exist anymore. So, you have to change with the times and be open to anything. Because I used to, like I said, I'm a product agnostic right now, but I used to not be quite that open-minded, I think.
Now, for several months, you have been warning your clients that we were going to have a market correction. First of all, why have you been concerned that there would be a market correction?
Well, if you take a look at history, I mean, we have this, we call it the 7-year syndrome, and I'm sure your other guests have talked about this, but, you know, we're in 2015, 7 years ago, 2008, we know we had a market meltdown.
Right.
2001, during 9/11, market crash. Go back, you know, 1994, the bond market collapsed and bonds went down 34%. 1987, I mean, just look at these 7-year cycles.
So there are these 7-year cycles.
So it only made sense, and here's the reality. You know me, I'm kind of a cynical person, but the professional traders, they can make as much money when the market goes down as they can.
They make money on volume trading.
Yeah, and they short the market.
Yes.
Right? And so we've had, you know, from 2000 to 2008, the market went up about 100%. Then we crashed. And then from 2000 to 2008 and 2015, it's up over 200%. I think some of these professional traders who can short the market and make as much money on the downside, I just think they salivate under circumstances like this.
Oh, they do, absolutely. That's how they make their money.
The problem is most of your listeners, or your viewers, I guess, have made their wealth in, let's call it their 401ks.
Or their careers, and they put money into the 401ks.
Sure. But that's where their nest egg is being built. Have you ever seen a 401k where there's an option to short the market? You've never seen it. So I call the professional traders, I always draw a little circle. Here's them and here's us. And I draw these little dots in this circle, and I said, we're the dot people. You know, and most of us, the only way we can make money in the markets is if the market goes up. So these guys can make, the professionals can make it if the market goes up or the market goes down. And as I said, with the market being so high, I know they're like going, oh my gosh, you know, what can we do?
Therefore, it's dangerous for 401ks where we're all long investments.
It's very dangerous. And I'd say, you know, am I going to be right or wrong? I don't know. But I just decided, you know, we were going to take a little hiatus to the sidelines for a little while.
Therefore, what have you done in the bulk of your clients' portfolios?
We've gone either to government bonds or to cash.
Right. And government bonds, short-term government bonds, I mean, treasuries, for instance, 2 years, 5 years,
very
something
short
like
term.
that. Right.
Mostly because every time we see something, even with this China, what's happening in China, whenever the world is afraid, you know, the flight to quality is treasuries. And so...
And again, the way you've structured your clients' retirement plan is that this is not going to affect their basic lifestyle at all. Their basic needs are paid for by, again, these guaranteed, safe, stable, annuity type investments. So this part of the portfolio that you put more in cash, they're not going to be saying to you, but, you know, Erin, I'm getting like, you know, 0.25%. I can't live on this. This is money that is allocated for what portion of your retirement?
Well, even within our annuities, some of the annuities have underlying, they call them sub-accounts, which are, let's call it mutual funds, the mutual fund equivalent. And let's say somebody puts $100,000 in, you know, their income is based on $100,000, you know, pretty much no matter what.
Right.
But we'd like to have someday their income based on $200,000. So we want to manage the portfolio. So we don't want their underlying value to go down. Now, it's not, either case, it's not going to tend to affect their income.
Right.
But we want to manage it for growth, just like we would manage just a traditional mutual fund portfolio or ETF portfolio.
What's going to be the trigger for you to get reinvested in, and what kind of, you know, investments are into the stocks and the bond markets do you tend to gravitate towards? I mean, are dividends an important part of your strategy, for instance?
Dividends are very important.
Right.
We have quite a number of clients who were senior executives at a couple of very large corporations. And, you know, they've been there 30 or 40 years. They've got these, you know, portfolios, and they have very strong, secure dividends. So, you know, if somebody had an entire portfolio of dividend-paying stocks, some of those could be considered a lifestyle investment. Why? Because remember, to be considered a lifestyle investment, the income, i.e. the dividends, must either be safe, predictable, or guaranteed. In a lot of cases, you could qualify some nice dividends from companies as very predictable.
Yes, I mean there are the dividend aristocrats, for instance, that have paid increasing streams of dividends every year for 10 years.
We love that.
So those are the kinds of investments that you're making. To go back to the liability issues, you had an experience as a teenager that has made you particularly aware of how an accident or a legal issue can really throw a monkey wrench into the best laid plans. So just briefly tell us again what happened and also why you want us to pay attention to potential liabilities out there.
Right. Well, just real quickly, you know, my dad died when I was 11.
Yes.
He left my mom with 6 kids and no life insurance. So life insurance would have been very handy,
right?
Because we were left destitute. When I was 16, I was on my way to work at McDonald's, my first real job. I hit a young man on a motorcycle and he was killed. And I was charged with involuntary manslaughter by the state of California, where I was living at the time. So we were lucky. This very nice attorney met with my mother and I, and he defended me on the criminal charges, and I was found not guilty. But 3 weeks after that trial was over, then the family of the young man sued my mother and me for just a ridiculous amount of money.
And I will just say, for the record, it turns out that through the trial, that in fact, not only were you not guilty, but that he had been speeding and had run into you.
That's correct.
Right.
Yeah, thank you for
absolutely.
No, that is actually very correct.
Right.
But we got through that, and when my mother, you remember things like, and my mother, God rest her soul, she's deceased now, but I remember she was so fearful when that lawsuit came.
Yes.
She said to me, well, because of you, we may have to pitch a tent on the high school football field, because she was afraid we were going to lose the only asset we had, which was our family home.
Yes.
So those lessons, I mean, I'm sorry, but you just don't forget that. So now remember, my family, we had nothing. And you can't get blood out of a turnip, but I work with clients who have a lot of money, who have worked 45, 50 years for what they have. And I would be remiss in not saying, let's make sure that whatever you have now, if one of your kids borrows your car, hits somebody, that if you're sued, they can't take your money away. And so it's a real expertise of ours, and it's something that we focus on a lot. Maybe too much, but.
What kind of insurance do we need, for instance?
Well, just obviously you want to have umbrella liability insurance on your homes and your automobiles. And people say, well, how much? Well, we always tell people 2 to 3 million more than your net worth. Because you want an insurance company to come in there and be the first line of defense. And so, that's a good ballpark, I think.
The other kind of insurance that you recommend that we always all have is long-term care insurance.
Yes.
How are the long-term care insurance policies now? Are there good policies still available out there at reasonable prices?
Right, there are, and there are very good policies. Now, one thing I will tell you, people should check out what they call equity-based long-term care insurance. And it's like having a pool of capital. The old traditional long-term care was you pay and you pay and you pay and you pay a premium, and then if you don't use it, you've lost all the money. These equity-based are, you invest some money, let's say, in $50,000, and tomorrow there's a pool of money 2 to 3 times that amount of money for use if you need it for long-term care insurance. Now, if you don't use it, the really nice thing is if you don't use it, there's a death benefit for your heirs.
Last question that we always ask everyone on Wealth Track is, if there's one investment that we should all at least consider owning, what would it be?
Well, I would say, since I wrote my book 3 years ago, I would say look at equity indexed annuities. Now, as I said, there's no perfect investment, but they've come a long way. And so usually they give some kind of a principal guarantee. The new ones offer some kind of an income, which is great. And then they do have participation of some kind in the upside of the market, but normally when the market goes down, you just get a 0 for that year. So you never have to participate in the downside. Again, you need to know the positives and the negatives. The negatives, pretty much, in the case of an equity index annuity, is you give your money to the insurance company, and now if the insurance company fails, you're just a creditor to that insurance company. That's a potential problem. And so, as I said, in my state, the state of Texas has an underlying insurance policy to cover that to a certain level. So I would say your viewers need to check, if they're going to look at an equity indexed annuity, that they check what the state's coverage might be, for that same investment.
All right, so possibly another tool in our retirement arsenal. Erin Botsford, thank you so much for being on Wealth Track again.
Thanks for having me.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is consider annuities as a core part of your retirement plan. With the disappearance of defined benefit pension plans, for many of us, Social Security is the only source of guaranteed income for life. If it is not enough to cover basic necessities such as housing, food, transportation, insurance, and healthcare costs, an annuity could be the answer. Kiplinger's insurance expert, Kimberly Langford, recommends looking at two basic types of annuities. Immediate annuities, which pay a fixed amount of money every year for life, and as the name implies, they start payments immediately. The other basic annuity is called a deferred income annuity, in which a person near retirement or newly retired sets a payout date at least 10 years in the future. The later the date, the higher the annual payout will be. We will have more information for you about annuities from Kim Langford on wealthtrack.com with this week's program. To hear more of my interview with Erin Botsford, go to the extra feature on wealthtrack.com and continue to reach out to us on Facebook and Twitter. Thanks for watching. Have a great weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Thornburg Investment Management, active management, global perspective. And the Fairholme Foundation.